everyone. I'll jump into things. I will be making forward-looking statements. We've got 10 minutes. I'll quickly run through. Our focus at P2 Gold is our GABS project in Nevada. We picked that project up in May of 21, and one of the things that really drew us to the project was the excellent infrastructure. We can drive on pavement to the project from Reno. We're about 45 minutes from Hawthorne, where we have an office. We have power on the property. We have a major transmission line up to the edge of the property, and we have water. It was permitted in the early 90s, and we're in the process of getting going on re-permitting that. So to build a mine, you need a good resource, but you need infrastructure, and there's always a trade-off between grade and the value of that infrastructure, because otherwise you have to build it. So we were really attracted here because of what we had overcome up in the Golden Triangle. So the project has a resource in all categories of just under 3.5 million ounces. We're at the PE stage, and I'll quickly run into our PEA economics. So this was a spot case on the far right at the time we announced the PEA. Since then, gold's gone up, copper's come off. I ran the current numbers around 2,700 gold, $4 copper, $30 silver, and you were about a 37.5% IRR. We're about a NPV 5 of 1.2 or 3 billion, and an NPV 15 of over 300 million. So you can see with a market cap of $9 million, we're treating Canadian, we're trading at quite a discount to the NPV of our project, which we truly believe will be a mine one day. So a couple aspects of the project. First 5 years is a heap leach operation, 9 million tons per annum. Now, this project was worked a lot in the 80s and early 90s. And historically, from what we've seen, we've looked at projects all over the world, we've worked all over the world, is once a project is marginal, it stays marginal. Now, why are we focused on GABS now? Well, there was a technology change in the late 90s. Lakefield Resources, or Lakefield Labs, came up with a process known as SART, sulfur acid recycling and thickening. So what it does, historically, if you had a gold copper heap leach oxide deposit, if you poured a lot of cyanide on that deposit, sure, you recovered the gold, but the problem was you recovered copper as well. And you couldn't take that copper out of solution, and it also impacted on your ability to pull the gold out of solution. So this SART process came out in the late 90s. First one went in the early 2000s at the Telfer with Newcrest. Since then, there are probably about 20 around the world. I think the biggest is at Yanacocha, Newmont's mine in Peru. And what it does is it allows you to pull the copper out of the solution and actually sell that copper, so you get another cash flow stream, and it recycles some cyanide, so it keeps your costs down. So that's what's enabled this project to go from something that was always on the margin, couldn't quite get into production, to what we feel will be a mine, and as soon as in potentially 4 years. Here's some of the ore. This is our oxide ore. You see we've got nice copper, and there's good gold. We've got Walker Lane trend-free gold in there. And there we talk a bit about that SART process. And it's not magic, it's just chemical equations. You add sulfur, you add sulfuric acid, copper drops out, and then you throw in some lime and you recycle the cyanide. And so it's quite simple, and the reagents you're using, there's nothing fancy. So that's our SART process, and that's the first 5 years. When we go from years 6 through 14, we're still mining some oxide, but we're also mining sulfides. And so we're building a mill. So the mill turns on beginning of year 6, 5 million tons per year. Nice gold recoveries there. And we're still running that heap leach at 4 million tons per year. Now, one of the areas for improvement, I should have spoke about this about a slide ago, is our heap leach recoveries are 78% gold, 54% copper. We feel that the lab work there, we need to do some more work using that SART plant in the lab. We feel we can get that gold recovery up to the low 80s and copper up to the mid to high 60s. And all of those increases in recoveries go straight to the bottom line. So those numbers we showed you earlier on are all going to be up by 10-15% for the copper side, and a few percent for gold, which, all pays bills. So here's our production profile. In general, 14-year mine life, producing on average 104,000 ounces of gold per year and 13,500 tons of copper. So a nice small mine on an equivalency basis. We're not the biggest on equivalency, but people like to hear that. At our base case prices, $1,950 gold, $450 copper year, you've got 174,000 ounce a year mine, which is a nice size gold copper mine. Here you can see a graphic of it. Currently, we're about 2/3 gold, 1/3 copper. We get that recovery up on the copper, a little bit on gold. You're going to see it swing a little closer to 50-50 gold copper. Capital costs $365 million to build the mine. The way we look at it, you get the mine up and running with the oxide, $365 million. Cash, that's paid off at current prices in about a year and a half. You're building cash, you build the mill out of cash flow, and by the time the mill's up and running, it's paid for. So from year 6 through 14, that's all cash that goes to either distributions or looking for something else. Operating costs, typical, we're at $1.55 for mining. That includes our rehandling. If you look at just straight mining costs, we're about $1.65, which is right in the ballpark for Nevada. Our heap leach processing costs are a little higher than you'd otherwise see, and that's the SART process, where we use a bit more cyanide. Milling is just right down the middle, what we'd expect to see, and G&A is just a factor of the tons we produce. So pretty good cost structure at $2,700 gold. We're banking over $1,500 per ounce that we produce. There's our resource. You can see 1.16 million ounces of indicated, 2.29 of inferred on the equivalent side. Looking at our resource as we're looking at our PEA, we're about 40% in the indicated category in that PEA. To get that all up into indicated so we can put it in a feasibility study, we need 10,000 to 15,000 meters of drilling. The nice thing about Nevada, it's a hell of a lot cheaper to drill there than up in the Golden Triangle. There's no helicopters, good infrastructure, as I spoke. So we can drill for about $200 US all in per meter. So, so for $2 to $3 million US, we can drill this off to feasibility level. Looking ahead at 2025, plans are get a metallurgical, that next round of metallurgy going. We've been waiting to get some lab time. We believe we'll get in the lab in February. 3 months of column work, a little bit of report writing. So say late first half of this year, very early second half of this year, we should see the results of that metallurgical testing. We're working on permitting the water wells. We've filed to re-permit. We've got the monitoring wells approved. Now we're waiting on the actual production well approval. And then we're going to continue with our baseline. We've already done a bunch. We need to do a bit more, but we'll get that done this May. We'd like to get that mining plan of operations filed because that sort of kicks things off, gets us moving along the timeline, and I'll show you in a sec where we think we can get in production. So this is what it looks like. It's a beautiful place to build a mine. There's lots of flat land. There's lots of room for laydown during construction. You can see off on the upper left-hand corner, you can see the paved highway running by. We've got roads throughout the property. So as I say, there's never a helicopter in sight. So just a great place to work. So we really like Gabs for that. Here's our timeline to production. We believe, cash and permitting willing, we think we can get in production in under 4 years. And as an example, there's a mine down the road from us, a little smaller. They went from discovery to production in 4 years. So with the new administration coming in the United States, we feel we can get through that 4-year hurdle. We just need to get some cash in the door. Here's our management team. We've discovered mines, permitted mines, built mines, operated mines. We know what we're doing, and we want to get Gabs up as our next mine. Capital structure, management owns over 22% of the company, probably have about $9-10 million in the company, and with a market cap of $9 million, you can tell we're a little bit underwater on our investment, but we're working hard to get that back. So that's P2 Gold, and I have 4 seconds left, so thank you very much.